In this episode, we speak with Michael Weisz, founder and CEO of Yieldstreet, the leading private market investment platform helping people dive into alternative investing with confidence and ease. Founding the company in 2015, Michael's team believed private market alternatives should be a fundamental part of investors' portfolio. From real estate, venture capital, private equity, art, short-term notes, and beyond, Yieldstreet investors gain exclusive access to a wide range of opportunities. Before Yieldstreet, Michael was an analyst and vice president of business development at a New York City hedge fund. He is currently a chief investment officer at Soli Capital. I'm your host, RJ Lumba. We hope you enjoy the show. If you like the episode, click to follow.
RJ Lumba is the executive chairman of Market Insight Media and the managing partner of Growth Cap. He is the host of Great Entrepreneurs, a podcast for driven entrepreneurs and business owners. Our podcast covers all topics related to the entrepreneurial journey, from ideation to execution to optimization and to reaping the rewards of a well-run business. In the minutes ahead, we'll share with you unique insights and tactics from some of today's most accomplished and inspiring entrepreneurs.
Michael, thank you so much for taking the time to chat with us today. It's a delight to be with you.
It's a pleasure to be here. Thank you for having me. I'm excited to have this conversation together.
Yeah, this concept or the whole area of private market investing is one that I've been dealing with for almost my entire career. And as platforms and technology came to the forefront with trying to facilitate private market investing, everyone kind of contemplated, well, how can this be done more efficiently? And you've succeeded. You built a company, you built a platform that's got billions of dollars flowing through it. That's not an easy feat. Why don't we start with how you came up with the idea? So the impetus, what were you doing at the time? And then, as part of that, what really compelled you to take that leap?
I love that question. And it's great to be here to share a little bit about my story and the journey at Yieldstreet. So for me, very simply put, prior to starting Yieldstreet, which has been nearly a decade, I was an active investor in the private markets, particularly spending a lot of time in specialty finance and other private credit type strategies. And one of the things that struck me pretty early on is as I would get together with my friends or my family or hang out at a holiday dinner or a night out with the guys, you naturally sort of talk about your day and what in my case, what I was investing in and the opportunities I was seeing. And very quickly, it became very real, recognizing that nobody in my sphere of influence, none of my friends, none of my family ever had access to this product. To me, that was so crazy because I was recognizing at the same time that the public markets were half of what they used to be. They were getting far more volatile, and that the outcomes that people were seeing were largely tethered to fewer and fewer stocks. And so, you're not truly getting the diversification that our parents effectively were able to get. Too many companies were staying private for too long, which meant that we're not going to invest in the next Walmart from a very early stage through a tremendous amount of growth. But rather, we're going to see the next Stripe or the next other opportunity that comes out at a $50+ billion valuation. So we miss a lot of that convexity. Hey, this is crazy. This is like a billionaires and an investment firm playground. The rest of the world doesn't see these products. And they're really important to having an essential diversified portfolio. So I think for me, that was the passion. That's where the recognition came from. But like all great stories, you need the right amount of luck and you need to be in the right place at the right time. And for me, a couple of things started to converge at that time. So one, the regulatory environment had a seismic shift in 2014 when the Jobs Act really started to become at play. And so for the first time, you're actually able to market these products and services that you never could before. So that was just pure luck at that right time. The second thing was, the way we used to engage with the internet was sort of very clunky, right? We used Google, we had our AOL Instant Messenger, even Facebook was sort of very content text heavy. Whereas really 2013, 14, 15 and beyond, there was a major shift being much more experiential. And the adoption and the time we would spend online was just going through the roof. And the reason that was important is because I thought we could do two things. One, you might be able to actually source the right people, the right audience effectively to deliver this investment product to. And two, the way in which we could communicate and educate people was getting far more interesting than a 50-page PPM that doesn't work. You need infographics, you need multimedia, you need webinars. you have to recognize that we, as consumers in every area of our life, demand a certain level of experience. And the investment world is no different. And so for me, it was the passion to help more people get access to diversified private markets portfolios. It was being lucky that regulation and the internet was in sort of its journey in a moment in time that fit with what I was passionate about. And then it was my expertise and the people that I partnered with to start the business, where we had a combination of my side, which was investment background, really understanding the market and talking to people, and my co-founder who really had a technical and a tech background. And so I think really bringing the two together to build a true fintech platform in core meaning was really how this thing got started and why we were really, really passionate about it.
And during that time frame in the 2013-14 time frame, there were many other platforms that were starting, and a lot of them over the years kind of morphed. They either got acquired or they merged or they kind of like shifted in their strategy, but yet you remain. What was the difference in your ability to kind of stay true to that initial vision and be where you are today?
It's a great question. I think there's one major differentiator that separated us from everybody else who had attempted to deliver some sort of private market exposure to the retail affluent audience. And the difference is being multi-asset. That was the single biggest difference. And I'll tell you why it was so important. When we started this business, we asked ourselves a very difficult question, but an important question. Who is your customer? Who are you in service to? And there's two possible answers, and you have to pick one, and you have to be very specific in making this decision. Is it the customer who's investing his or her money in building a portfolio? Or is it the asset manager whom I can introduce to a new audience of prospective investors and help raise money? It's a really important question, and I'll tell you why. If you're like Yieldstreet and you're in service to the investor, then I have an obligation, which is to do two things at all times. One is to identify institutional quality investment product, so high quality investments. And two is to deliver to you the right product at the right time. So there could be, let's just say the two of us were users who showed up on the platform today. We may have different things in our portfolio right now. And so in order for us to build a healthy, diversified portfolio, that next investment might be different for you and for me. So for me, maybe it's private equity. For you, maybe it's real estate. If I'm only here to offer you one product, say real estate, then I can't really serve Michael in the right way. And candidly, I can't serve you in the right way on your next investment. So needing to have diversified product and the right product at the right time. In 2021, everybody was risk on, show me private equity, real estate equity, art equity, growth story, et cetera. 22, 23, sentiment changed rapidly. Inflation was present. Geopolitical risks were there. Who's the next US president? What are interest rates going to do to my portfolio? That turned risk off pretty quickly. And people didn't want a 10-year opportunity. They wanted a 2 to 3 year credit opportunity. Pay me interest monthly or quarterly. Keep me senior or mezz in the cap stack. Now, if you're only going to serve your clients one thing, be it private equity, be it real estate, be it fractional art, you're not helping them truly build diversified portfolios. You're helping the real estate owner operators find new investors. You're helping the private equity asset managers find new investors. I appreciate that. But that's who your customer is. So for us, because we defined our customer as the individual investor who we're in service to, we had no choice but to recognize that it was important that we help them build diversified portfolios. Now, once that was a truth, the question was, well, okay, what do we need to build to deliver on that promise? So we have to build this massive distribution infrastructure. Think of the foundation for a 100-story building versus a 10-story building that could allow people to transact and invest in 3C5, 3C7, 40 Act interval funds. So that's the fund type. Private equity, private credit, real estate debt, real estate equity, SFR, BFR, CLOs, and the list goes on. That infrastructure to distribute asset classes or investment solutions across the asset complex and up and down the cap stack doesn't exist anywhere in the world. Built that from day zero, and it was expensive and it took a lot of time, but it was foundational to be able to deliver for our customers. What happened after that? One, we're building long-term relationships with our customers. right? So we're going after 30% or more of your portfolio. If you're a single strategy business, you can only go after 2, 5, 7% of the portfolio. So when you look at the business, unit economics, the profitability, the health of the customer acquisition strategy, you cannot compete with us because you can only go for 20 or 30% of what we can. And the best way to sort of bring that home is 40+% of our customers have 10 or more investments on a platform. Mm-hmm. We don't sell you a deal. We build a relationship and we help you build a portfolio. Mm-hmm. Now, when it comes to consolidation and others being successful, in time, you've heard every other platform say, hey, we're going to offer other products. Nobody else has been able to do it. And it's not because they don't want to, and it's not because that we don't necessarily share the same conviction in the requirement to democratize access to these products. It's because like an old bank, once you have a legacy system that's specific use cases built for X, let's call it real estate equity, you cannot just simply turn on that next capability. And so we acquired Cadre, which was a leading real estate online platform, in part because of this thesis. They had a very valuable customer base that had demonstrated a willingness to invest online in the private markets, but had only been shown real estate equity. Those customers are actually converting at an incredibly high rate relative to the Yieldstreet organic customer because they're itching for diversification. So we've done a great job there. And because we built the platform the way we did, we were able to take out over 85% of the costs in the Cadre platform and migrate and integrate that capability onto Yieldstreet. I know that was a long-winded answer, but I think it was important to get thorough and sort of really understand the differentiator and why it's so important to define your customer and to be true to that.
Building marketplaces is extremely challenging because you're building two sides and it's a chicken and egg situation frequently. You were talking about the long-term relationships you can establish and grow with your individual investors. Let's go first to who is your target investor? I'm sure there's different types that you target, but maybe who was it in the beginning and who is it now?
So that is a great question. I think, listen, it's been a journey for us and it's been somewhat called, we've made a lot of mistakes. Others might say we've paid for an expensive education at the behest of some great investors that have entrusted us and believed in us. When we started the business, we were very altruistic. We wanted to make private markets accessible to everybody. And I think that's a beautiful thing. And one day we'll be able to, as the industry, to solve for that. But you realize within due time, those unit economics don't work. And so we've had to continuously home in on exactly the right customer that we could provide the best value prop for. So today, our customer is very defined and it's very specific. It's a $500,000 to $10 million investable assets. We're targeting the self-directed component of the US-based investor. That represents 17 million people in the US right now of the 24 million accredited. And within the self-directed bucket, there's $9 trillion of self-directed cash and investments being made by this audience. We think that over the next 2 to 5 years, you're going to move from 5% allocation to 15 and from 15 to 30. So there's a 1.3 to sort of $3 trillion opportunity in the private markets, specifically self-directed US $500,000 to $10 million customer. That's us.
Is there a product that's kind of like the intro product for an average investor? Like you can first say like, hey, why don't you try out investing in private equity? You've probably heard about it. You know private companies, you know, some of the names of them. Why don't you try that? Do you have a process? You know, I'm sure it's different depending on who the investor is, but generally how you acquire these customers.
So the journey is really important. It's really specific. We're pretty sophisticated in how we approach people. So we have different psychographic profiles and different lookalike models for different people at different places in the journey. So I can't answer sort of all of that in one sitting with you. But to get specific, the trend that we see, the data that we see is there is a product that sets itself apart in a material way from all other products in being, let's call it gateway, that first product, okay? And there's a reason for it. It's our short-term note product. And what that product is, it's a 3, a 6, or a 9-month product. It's a credit instrument. It's quite short in duration and quite safe. You get sort of a payment month 1, month 2, and let's say month 3, you get your money back. And the reason that's so important is, like, for example, you said private equity as an example. Think about the pitch. For all these reasons, we think this is an amazing opportunity for you to help diversify your portfolio of its core private equity big name. why don't you give us $25,000 for 10 years and you can target a mid-teen return? You're like, whoa, that's a big moment, right? Like that's a long commitment. That's not a cheap dollar. Versus on the short-term product for someone who's exploring private markets and they're new to the platform and they're new to diversifying their portfolio, we know a few things about them. We know you really want diversification. We know you really want less vol, and we know you really want to achieve better returns. But you want to test it. So we call this moments of joy. How do we create moments of joy at Yieldstreet? In your public market portfolio, you could look at that 10 times a day and you'll see something different. There's price action, there's movement. You can feel great about yourself. You can feel really bad about yourself and sell it quickly. But there's activity and emotion being created. In your private market portfolio, none of that. You put the money in, nothing happens. A year later, you check out it's doing. So the short-term note product is that creates those moments of joy. You get to experience a little bit of the private market. You get that payment. You're like, wow, I feel good about myself. I made a good investment decision. I got some money. This is working well. I'm building some trust. And then by the time you get your money back, you're like, okay, I can do this. I can invest in 3 or 4 things and build a diversified portfolio. And I'm okay that it takes some time. Mm-hmm. So that's why the short-term note product is far and away the first product, called the gateway product. And that's sort of how we think about introducing and bringing you into the private markets.
We've had other people on this podcast where they started out as a platform and then they evolved into, say, enterprise software for institutional investors. What's the long-term vision for Yieldstreet?
Listen, the long-term vision for us is to really build the preeminent digital platform for the affluent retail investor to diversify into private markets. There's a couple of major things happening, and we invested the last 10 years of our life building something incredible. And we believe that it has huge growth opportunity in front of it. So let's look at what that is, right? So one, you have $100 trillion of what we call money in motion moving from boomers to the next generation around the world. In the US, there's $70 trillion. Who are these people, right? We just conducted this fresh analysis with one of the leading consulting groups right before New Year's. So who are these people? What do we know about them? So we know that they're younger, okay? So they're not going to go for 18 holes around the golf with a 65-year-old, 70-year-old advisor telling them about house portfolio 1, emerging market 2, and et cetera. So what do they want? They want a digital experience. They're 3 times more likely to invest in the private markets. They value content tremendously, but you have to deliver it to them in the way that they expect to be experienced and consuming that content. So infographics, multimedia, webinars, interesting PowerPoints, different ways of simplifying what has historically been sort of complex or demystifying private markets. There is a tremendous amount of energy across the entire industry, from Apollo to KKR to BlackRock, enormous, right? Blackstone, Blue Owl, Carlyle, Stepstone, Hamilton Lane, we can keep going. That represents over 85% of the dollars being invested are focused on reaching the retail channel. A huge amount of that effort has gone through the wealth channel, where the large institutions have said, hey, we are going to have this partnership with you, or we're going to go B2B to C. And I think that made sense as an entry point for these institutions. They're not designed or built for a direct-to-consumer relationship. Mm-hmm. So that's changing aggressively right now. 3-4 years ago, there were, 50 interval funds? Today, there's over 500. And so the amount of effort that the manufacturers of product, the investment managers, are putting into creating accessible solutions for the retail audience is demonstrating how serious we are about recognizing that the portfolio is no longer going to be 60-40 in stocks and bonds. It's going to include a material part in the private markets. You're going to go from alternative to essential, right? And that's happening. Now, ask yourself, who is positioned to deliver a direct-to-consumer experience? Who has a delightful platform? Who can deliver all these types of structures and products and funds and diversification? Who can meet the customer where they are? RJ, what we didn't talk about is what are the different experiences people have? So we believe there's 3. There's do it myself, guide me, do it for me. There's a passive solution, right? Like in the US, we went from 6% of homes owned stock in the 60s to over 60. What happened there? With technology innovation, we have passive solutions, mutual funds, ETFs, model portfolios. Doesn't exist yet. We built it. Mm-hmm. But for us, we see this as really being the beginning of a major tipping point. Mm-hmm. Where $1, $2, $3 trillion over the next few years is moving into the private markets on the self-directed side. Forget the advised side. Mm-hmm. There's tremendous amount of energy there, and some great companies built great solutions for advisors and for the wires to deliver that product.
Mhm.
Within the self-directed space, there's nobody that could come close to the capabilities that we built. So for us here at Yieldstreet, the team is like excited to feel like, you know what, we built something special. We invested all this time, and we were right. The industry's right here. The consumers are more aware of private markets. People want them in their portfolios, and we could deliver a differentiated experience and really deliver value to the customer. So that's what we're focused on building.
I could go on and on. We're coming up on time. I do have two final questions I like to end all conversations with. One is, can you tell us about a person who has had a profound influence on you?
There are a lot. Listen, I'm a big believer in life where we're all sort of on the same journey, if you will, in our own unique way. And a big part of that journey is making mistakes, having challenges, learning from them, and hopefully growing from them. Now, there's two ways to go about that, is my belief. You either approach life in the way I just mentioned, and you deal with it and you learn from each one, or you find friends and mentors with wisdom and experience that say, hey, Michael, that could happen around the corner, or that happened to me. I really think, you ought to think about this a little bit differently. And so if you ask my wife, you ask my kids, they'll always tease me that some of my closest friends are 20 or 30 years older than me. And it's because I think there are so many people that have so much to offer and so much you can learn from. And sometimes I'll be a contrarian and pick someone who's, failed miserably in a very public way, because there are lessons that person can offer me that most other people can't. And so I have a pretty healthy mix of people in their 60s and 70s that I spend time with, that I've learned to, that are mentors to me and are important to me, and have really helped me along this journey navigate some of the biggest challenges, and quite frankly, avoid some major missteps that could have happened. So absolutely think that a lot of people got a lot of influence on me.
Last question. Can you tell us about a charity cause or other endeavor that you're passionate about?
Yeah, I can. So there's a couple things that my family is really passionate about. Number one is widows and orphans. I think that, to no fault of their own, these people are dealt huge, huge disadvantage. And I think one of the most important things for children is to have a sense of stability, really a sense of confidence and a sense of self-worth. And in every little way, if the breadwinner of the family isn't there, and these kids are going through not having a father to be there and to be strong and sort of teach you all the things that great fathers do, but also the economic challenges and the other issues, that kid is really dealing with a huge, huge, huge disadvantage. I think it's very easy to step in for those of us who can and provide different forms of relief, whether it's through financial assistance or Big Brother. So that's huge for us, like just globally. Widows and orphans is number one. Number two, I think life saving is a huge initiative that there happens to be, I think it's either frame, but there's an ambulance that Yieldstreet investors sort of crowdfunded, if you will, and funded $350,000 for an ambulance there. That ambulance, ultimately at $500 a life, we'll say that $500 a life, if you amortize the number of trips it will likely take over the course of its life. So I think if you just get down to the numbers and say, I could save a life at $500 a head, I'm in that trade all day, every day. So let's focus on emergency medical care. And the third and sort of last one I would mention here is education. Really try to invest, particularly in my community where my kids go to school, and thinking about, hey, hopefully we'll be in the school for a very long period of time. What can we do to advance education? And what can we do to advance social and sort of mental well-being throughout the school, social, emotional, as well as the curriculum, and then try to take what we learned here and offer that to as many places as possible. So those are the three things that are really important to us and gives us a tremendous sense of joy.
Excellent. Well, Michael, I want to thank you again for taking the time to chat with us today. It's been a wonderful conversation.
Thank you for having me. This was fun, and happy to do it anytime you'd like.